Okay, hi everyone. Welcome to Vantage Educational Series for today. So for those of you guys who just joined, a big welcome, right? So for today, we will be covering on mastering supply and demand zones with market structure. So this is actually a follow-up from what we covered in the previous last Thursday session, right? So for that session, we covered on basically identifying supply and demand zones using specific candles. So for today, it's a continuation of that, right? So how this will be done is that we'll first go through a quick summary of it. So for those of you guys who did not attend last Thursday's session, right, not to worry, we will be going through a quick summary of how we identify supply demand zones using the concepts that we've covered, right? And then after that, we'll also be using the TradingView example. So we'll hop onto the TradingView charts and essentially go through an example on how we can apply these concepts. So just a quick introduction of myself. I'm Lee Sing, right? So this is me. I'm a FX strategist, right? And I'm also part of the team that's recognized by the Technical Analyst Awards as finalist for the best FX research for 4 consecutive years. You can also find me on LinkedIn. So if you guys have any questions with regards to the analysis done on Wednesdays, Fridays, or even the educational series, right? You can you can either put your questions under the Q&A chat box that we have over here, or you can also reach out to me on LinkedIn. And separately, if you guys have any specific topics that you like us to cover or any charts that you like us to look at, right? So do join us for our live analysis session on Wednesdays and Fridays. So this is where we will be hopping on to the charts to show you the trade setups that we're looking at. At the same time, if there are any chart requests, we'll take on that as well, right? So yesterday we showed on pound yen and pound Aussie. We also did a setup on gold, right? So that turned out well. So yeah, so that's what we'll be covering. So for tomorrow, we will be doing a review of the calls that were made yesterday, so on Wednesday. So just a quick disclaimer before we start. The information presented over here, it's for educational purposes only, and it's not to be treated as investment advice. Along the way as well, if you guys have any questions, right, put them under the chat box. So if you have anything with regards to what the content that's being covered right now, later on when we hop on to TradingView, right, if you have any questions with regards to that, right, just feel free to type your questions under the Q&A chat box or even under the chat box that you have here. So this is the agenda that we will be covering for today. We will first cover a summary of the supply and demand zone concepts, right? So this is a brief summary of what we have covered last Thursday. And then following which we will also be covering a bit of the concepts on the blocks and liquidity sweeps. And then next we will be using these examples on TradingView. So for this, I'll hop onto Aussie dollar, right, just to show you a full chart breakdown from the 4 hours down to the 1 hour time frame, right? So essentially how we can apply these concepts. And then finally, we'll be doing a quick summary of what we have covered so far in this 30-minute session. So let's first start with a summary of the supply and demand zones concept, right? Maybe before I start, right, just to get a brief overview of what you guys know here, right? So can you guys just type in the chat box as well, how many of you guys are familiar with just identifying supply and demand zones concept, right, based on specific candles? So maybe just put your response under the chat box, right? So are you guys familiar with it? Do you trade using this as well, or is this something that's completely new? So I would say that to some extent, it is very similar to support and resistance concepts, right? So this is widely used in technical analysis, and it can be very useful in helping you to identify zones, right, for reversals or continuation. Of course, you do have to tie in with the higher time frame picture as well, right? So bullish, bearish market structure. So we'll see examples of how that play out in a moment, right? So let me just bring out the chat box as well. So I'll bring out the chat box and the Q&A box on my other screen. So I'll leave it running there. So if you guys have any questions or anything, I can see it immediately. So let me just bring that up. right? And yeah, feel free to ask if you have any questions. Okay, so let's start with a summary of the supply and demand zones concept. So you can see over here, right, at like with what we've covered in the earlier session. So essentially the idea of supply and demand areas, what's first and foremost, the most important thing, it's to identify the market structure, right? So the market structure, especially on a higher time frame, would be a guide in terms of where the market is heading. So in this example, you can see, right, what we have over here, its prices are in a bearish market structure, right? So if you look at what we have on the left, as you can see here, so let me just bring out the annotation. So you can see, right? So let's just focus on this portion of the chart to the left first. So let's focus on this area here. You can see that this is a bearish market structure. So why is this a bearish market structure? Because you can see prices are forming your lower lows and lower highs, right? So in this example, I've marked out the highs and lows here. The highs are marked out in this gray dotted dots that we have, and then the lows are marked out in the blue dots. So you can see over here, right, each subsequent gray dot is lower, each subsequent blue dot is lower as well. You can see prices are forming your lower lows and lower highs. So with that in mind, what this tells us over here is that at least to the left of this chart, right, so this portion, to the left of this purple line that I have drawn, prices are in a bearish market structure because of the lower lows and lower highs that are being formed. So after we have identified this lower lows and lower highs, right, this bearish market structure, what we want to know next is that in a bearish market structure, what we're expecting is that we're expecting the highs over here to hold, right? So in a bearish market structure, you're not expecting the highs to be broken. So you can see over here, right, each gray dot, right, it's lower, so the highs are holding. And what's happening is that the lows itself would be the ones that will constantly fail. So that's the general thought process, right? When you look at market structure and also looking at basically how prices are reacting on these zones. So once we have this process in mind, the next thing that we want to do is to identify this. So you can see that in a bearish market structure, right, we're expecting the lows to go. So you can see in this area itself, right? So I took the extreme, the last candle that we have over here. So this area itself would be our demand area, this zone that we have over here. You can see that following this, right? So essentially price came in, it reacted to this region that we see over here. You can see this slight push up before it fails. So what this shows us over here is that when demand fails, which is this zone, right? So focus on this area. So when demand fails over here, it creates our supply region, which is the supply zone that you see here. So let me just remove this drawing. So you can see over here when demand fails, right? So this is the demand area. You can see this region over here. When demand fails, price came in, interacted with this zone, right? So what it does is that it acknowledges that there is some kind of buyers entering into this market, but it's not strong enough to push prices higher. And what you see following this is that when price fails, right? So when demand fails, it creates a valid supply area here. And this is important, right? More importantly, is that it has to be aligned with your market structure. So you can see that first, we identify the market structure. You see your bearish market structure, following which you can see that when demand fails, it creates supply area. So in a bearish market structure, what we're expecting is for supply zones to hold and demand areas, or rather the lows essentially, to fail. So that it's the idea, right? So you can see that when demand fails, it creates supply region, which prices came in, respected these areas, and then again, you see the same thing happening over here. A new low is created, right? So this demand area, a new low is created over here. Price came in, interacted with this region, as you can see, before it fails completely, it closes below this area. So this interaction itself, right, once demand fails, so only after demand fails, it creates a supply region, supply zone over here. So this is the supply area. You can see that when demand fails, so on this point onwards, when demand fails, price came in, tapped into the supply area, and you can see a whole bunch of supply area being formed following which. So how can we tell when there's a confirmation and a change in trend? Is when there is a break in structure. So you can see over here, right, at least from this portion of the chart to the left of it, the lower lows and lower highs are formed, right? So noted by the gray dots and the blue dots, you can see that each subsequent gray dot is lower than the previous one. But what happens when we look at the left of this area? So this is the first sign that there's a change in trend here. So focus on this portion of the chart. You can see that this is my last gray dot that I have, the last low. And then if you look to the right of it, you can see that this dot that we have over here, which is the high, not the low, this is the high, right? And the high over here, right? So if you compare these two highs, you can see that what happened essentially is that price pushed up and it broke above this high. You can see that it broke above the last high that we have here, this region. So what this tells you is that there is a change in trend, right? From the bearish downtrend that we have right now, we have a sign that with this break in structure, we could be seeing a new bullish trend form. So that is the idea now. that we have, right? So in a bearish market structure, you see supply zones holding. In a bullish market structure, we want to try and find demand zones, right? So it's likely that demand zones would hold. So that's the idea, right? So you can see coming into this region, what we have over here, right? Again, supply zones being formed. And what we want to do is to basically hop onto this chart, right? And identify the interaction between demand and supply. And this is what you are seeing here. So let me just remove this purple line. You can see this region. This is the first interaction. How so? Price came in, tested into this region. You can see this area over here. Following that, you can see the interaction or the acknowledgement of the supply region before it fails. So what this tells you, again, right, using the same concept, when there's an interaction between demand and supply, when supply fails, it creates a demand region. So you can see over here, right, demand region is created. And what's more important is that there is a break in structure. Okay, so if you're seeing something like that with no break in structure, this demand region might not hold. But in this case, right, there's a clear break in structure. So what we want to do next is to identify the demand region that hold. You can see that this is the demand area. How is this a demand area? Because it interacted with supply previously before it fails. And then you can see that now it creates a new demand zone. So if you did not catch this first area, that's fine, right? But you can see that the confirmation really comes after the break in structure, and following which price came in, tap into this area again, create again your new demand area over here. And you can see that in terms of the structure, right? Just look at the highs and lows being formed, right? Coming into this region, you have basically higher highs and higher lows being formed. Okay, so I hope that this is clear in terms of the concept of an interaction between demand and supply. So understand that whenever demand fails, it creates a supply region, right? And when supply fails, it creates a demand region. As to whether it's a definite buy or sell, we wouldn't know, right? So we want to zoom into the smaller time frame and try to find as much as possible confirmation on the smaller time frame so that there's a higher probability of the trade. Okay, so I have a question, right? So what is the best time frame to know more about supply and demand in an intraday trading decision? So in general, I would start with the 4 hours time frame and then going down to either the 30 minutes or 1 hour to refine it, right? So that's generally the time frame that I would look at. So I hope that answers your question. So with that, let's take a look at the next slide. So for the next slide, we will be looking at would be on liquidity sweeps and order blocks. So maybe let me just explain a little bit on the concept of order block, right, and how it works. And then after that, right, we can actually look at this example and see how we actually apply the example that we saw, or rather the concept that we see in this example that we have on the chart here. So just to explain a little bit on the concept of order blocks, right? So imagine this, right? So in general, we always cover support resistance areas, right? So if you are a completely new trader coming into technical analysis, what generally covers, right, at the start of technical analysis is identifying support resistance areas. So in this example itself, right, let's just use the example of a resistance. So let's say, right, so if you have a clear resistance area over here, you can see that price came into this region once, rejected this area. So we saw this sharp rejection. Coming into this region again, what happens usually, right, when there is a strong resistance or a sharp rejection of this area the first time, what happens coming into this region is that you entice sellers to come into the market. So assuming that prices are forming your lower lows and lower highs, right, that's bearish market structure, you see resistance, a sharp rejection of the resistance, and coming into this region again. What also happens here is that you have sellers, right? So people who saw the rejection over here once, did not get in the trade, would likely get into the trade the next time, right, coming into this major resistance. So what they will do, right, so if you have a sell position over here, what you'll do is usually the stop losses will be lying slightly above this region, right? So if you have a sell position here, then the stop losses is the opposite direction, right? So essentially you have the buy orders that are sitting here. So imagine, right, if people enter the sell orders here in this major resistance, coming into this major resistance, you have essentially a lot of orders, the buy orders that are lying slightly above this resistance. So what we term this areas, right? So imagine this lot of orders here. These are essentially what we call liquidity. So the idea of liquidity is just basically an area where you have a lot of orders that are lying over here. So this is the liquidity that we have lying slightly above this key resistance area that we have here. So imagine now from a bigger player's perspective, right? So if you want to get into the trade, right? So if you want to get into the trade as retail traders, we can just take shorts, right? Our move itself would not affect price much. But if you're a big player coming in with huge volumes, right? Coming in with a sell order over here, they need to find essentially a place where you have a lot of people taking the direction, the opposite direction. So if you want to sell, essentially you need to find people to buy it from you, right? So in this case, right, if you're a big player coming in with huge volume, you need to tap into an area where essentially you have a lot of buyers over there that are willing to take it at a certain price. And this is important because if this player, so imagine if you're a big, huge institutional player coming into this region and you're just selling, entering these positions, right, with huge volume, what is going to happen is that it will drive market prices much, much lower, right? So what you're going to get is probably very bad entries over here, given that you're coming in with such a huge volume. So what usually happens coming into this resistance area is that they want to find areas that have a lot of buyers that are just taking their orders there so that it doesn't move prices much. So that's the idea behind this, right? So you can see that coming into this region, what usually happens is that price or the players would push prices slightly higher to tap into this area, right? Recall that there's a lot of buy orders in terms of stop losses or even breakout traders that are buying over here, right? So essentially either waiting for a break above the resistance, number one, or basically the stop losses, right, for the sell orders that they have entered. So with that in mind, right, what usually happens is that they will push prices slightly higher, so buy with a bigger volume to drive price into this liquidity area that we have over here. So this is the buy side liquidity. So drive prices to basically tap these orders, right? So essentially these orders over here, you have a lot of buyers who are willing to take it at a certain price. So once they have that, right, they're able to enter their sell positions before selling with a bigger order to drive prices lower. So what this shows over here is that in terms of an order block, right, what you usually see is a sharp spike up before a strong reversal in the opposite direction. So this spike up, it's essentially, you can term it, there are many terms for it, right? Market manipulation or order blocks, right? But the idea behind this is basically prices just pushing deeper into an area of liquidity before it continues to the downside. Okay, so this works for sell order blocks or bearish order blocks, right? Same thing for bullish order blocks as well, a huge spike down before it continues to the upside. And this area itself would be the order block. So imagine this, right, from bigger players' perspective. So right now they have two positions open, right? One, so let me just clear the drawing so that's easier to imagine this, right? So you have one position open where essentially prices coming into resistance and they bought with a bigger volume to push prices lower before selling with a higher volume. So they have two positions, right? The buy positions to push price into this area of liquidity, or this to tap into this buy orders lying above, and also the sell positions. Your buy positions in this case would be in a loss, right? Because prices are pushing much lower. So what happens following this is that you can see when price taps into this region again, they will end up closing the buy positions that you have over here. So this order blocks itself would then serve as the entries. So this is just a general idea of how it works, right? So in terms of liquidity sweeps, is basically the idea of tapping into a region where you have a lot of orders that are lying slightly above and below. It can be below and above a key support resistance area. So with that in mind, right, I'm going to show this example that we have here, right, just to see how we can apply this concept onto this chart example. So this is actually a chart that's taken from TradingView. So we'll explain a little bit on this, right? So again, right, as we have mentioned so far. So the most important thing is to identify our market structure. You can see over here, the bearish market structure came into play with the break of the low, right? So again, over here, right? So if I were to draw out the market structure, you can see that this is the last low that was formed over here. Price pushed up and you can see this internal range, right? So price did not break the high and low, and the following which you see a clear break below the previous low. So this bearish market structure comes on the break of this low that we have over here. And once this bearish market structure its form, you can see that when price pulls back into this region, right, this is where we see the liquidity sweep. So I will zoom in onto this portion of the chart in the next slide, and you can see the liquidity sweep here. But the idea behind this is basically you can see that there is a key area where price came in and interacted multiple times before price sweeps slightly above it just to tap into the pool of buy liquidity, right, or the buy orders here before it continues to the downside. And once that happens, this would then create an order block. And you can see that price then comes into this region again, where you can take a sell here. So that's the general idea, right? So now let's focus on this portion of the chart. So I want to zoom into this area to show you how price interacted with this zone, right? And what happens after price swept it. So let's take a look at that. Okay, so yes, in response to your question earlier, yes. So on the H4 and H1 in the intraday, you're very welcome, Chong. Okay, so let's take a look at the next slide here. Okay, so it's basically a zoomed in version of the previous slide. So this is pound dollar on the daily, and right now I'm zooming in onto the 4 hours time frame. So earlier I mentioned to focus on this portion of the chart. You can see that this is the H4 resistance area. It was the previous support area. Price came in, tapped this area. You can see multiple interactions with this zone, right? So essentially testing as both support and resistance. Coming into this region, resistance again before it pushed prices lower. You see acknowledgement of this zone multiple times. So what this shows you is that over here, right, when people come into this area, right, you have sellers pushing prices lower. What also happens is that it creates a lot of what you can term buy side liquidity. Essentially, the simplistic term for it is just there's a lot of buy orders lying slightly above. They can be your breakout traders, right, trying to take a long from here. That's one on the breakout. The second one is basically stop losses, right, for the sells. So this area over here, which you can see price came in, right, tap into this area. So you can see this sweep. So this is another way you can look at it, is the liquidity sweep, right? So essentially it tapped into this pool that you can see over here. So it tapped into all these buy orders, right? Before it continues to the downside. Essentially at this price, you can see that there are many people who are willing to buy from the bigger players, right? Before it continues to the downside. So this then creates an order block here, as you can see, right? So let me just go back to the daily chart so that you can see it clearer. So you can see on the daily chart, it's a lot clearer. So on the daily chart here, let me just clear the drawings. So you can see this region. Oops, sorry for that. Just before that, let me just go back to the candlestick pattern. There we go. So this is the daily, right? So you can see the resistance zone that we were talking about, the interaction. And then following which you can see that sweep. So you can see that price did not actually break and close above it. What happens is that it actually wicked above it before it continues to the downside. And this is the region here. So it creates a daily order block. So this is how you can apply the concept, right? So following that, I actually zoomed down to the 4 hours where we saw the interaction between this H4 resistance area before price swept above it and continued to the downside. And this is another example. So recall that when I talk about order blocks, I said that there is a sharp spike up before continuation to the downside. So for those of you guys who are not very familiar with candlestick patterns or candlestick charts in general, right, you can actually look at this playing out in the line chart as well. So take a look at this, right? Same interaction, there's support area here. You can see, right, price came in, bounced twice on this region and then broke below it, tested as a resistance. You see this area, price came in, you can see this sharp spike, tested as resistance, held multiple times before you see a very sharp spike up. So price drove prices up here, sharp spike up, sweep the area, and then it continues to the downside. So usually for order blocks, it's sharp spike up. For bearish order blocks, it's sharp spike up before it continues to the downside. You can see in this example, right, if I switch it to line chart, this is what you see here. So the one highlighted in blue, so you can see essentially it's a sharp spike up to sweep these areas of liquidity before it continues to the downside. So this creates a valid order block region here. So this is on the daily, right? So I took the candlestick off the daily. So this is the gray zone that you have. The one in line chart is just to show you essentially that if you zoom into the smaller time frame onto the 1 hour, you can see that this would be an even sharper spike up before it continues down. So this is another way you can spot potential order blocks here. But what's important is to first identify the market structure, right? So I cannot emphasize this enough. You need to understand that on the higher time frame, right? Is there a clear break in market structure, bullish or bearish market structure? And then following which you can identify these areas of liquidity. If there's a order block over here with a sharp spike up, then this area, when price revisits this region, this is one region that you want to consider, right? So you can wait for smaller time frame confirmation. It can be clear break of support and resistance areas. It can be a double top, right? So depending on what price plays out here, what is set up. So this is the idea. So let's take a look at what we can do right now with TradingView. So let's hop onto TradingView and we will do an example on Aussie dollar just to show how these concepts apply. So let's take a look at TradingView. So let me just switch my screen. Okay, so can you guys see TradingView? So you should be able to see the TradingView chart, right? So if you can you please just put something in the response tab so that I know that you guys are looking at the right screen? Okay, so let's take a look at TradingView here. And okay, so I am guessing that this would probably be right? So you guys can see the screen. So let's take a look at what we have, right? So on the 4 hours time frame first for start, just to see how this concepts apply. So let's take a look at this. So I'm just going to remove all of this drawings. Oops. And this as well. Just give me one moment. It seems like the purple zone is just stuck there. There we go. All right, so this is on TradingView right now. You can see this region. Okay, so here on TradingView, right, this is the 4 hours time frame. So you can see this region itself, right? This was a previous area. So I'm just going to move back slightly here. So you can see that this region itself, there is a resistance area. So you can look at it in terms of supply demand areas, or even if you want to look at it just in terms of graphical levels, you can see this area. This was a previous resistance level, right? Resistance turn support level over here. So you can see this area itself, right? So this is actually the last support region. You can see that price. So if you zoom into this portion of the chart, this candle over here, let me just zoom in slightly. You can see that this is consolidation. So this is actually the 4 hours time frame. You're seeing these small candles. But if you zoom down to the 30 minutes, the 1 hour, you can see that it's actually consolidation here. This region. So essentially what you have, sorry for that, right? So essentially what you have over here is you can see that price came in and price tested this supply area, right? And following that, you can see a clear break above the supply area. So you can see that this candle itself, right? Recall when we talk about supply demand area, when supply fails, it creates demand regions, right? So when supply fails, it creates a demand region. So this would be your demand region here. So you can see that this candle itself, right, still hold below supply before it fails completely. So this would be the demand region. You can see price came into this area, right? This is the demand region. It came in, tapped into the demand region over here, and then continue lower. Now, what's important on this region itself, when price came in, it acknowledges the demand region the first time. You can see here, acknowledges it, and it pushes up. What this also shows us that it creates a bearish market structure, right? So you can see that a new low is formed over here, and then price came in, interacted with this region again before it fails completely. You can see this region itself. So this is the area. So let me just change this markings, right? So you can see over here, let me just remove this. So I'll extend this area till the interaction. And you can see that once this area fails, it creates two things. It tells us, right? Number one is that you have supply that is being in control. And the other thing, it's also that it's a bearish market structure here because price broke the previous low. So with that in mind, right, once you come into this region, you can see that this candle itself still held within. So again, right, interaction of supply and demand zone would create when demand fails. So this blue area was demand. When it fails, it creates supply region. You can see again, right, this would be the supply region formed over here. So what's important with the supply region is that you can see this region. So let me just put it in a different color. So this is supply, right? So because this is the candle that still holds within the demand area that we have before it fails completely. And you can see when that happens, it creates a supply region. Now, what's important to keep in mind with this is that in line with the supply region, what you have over here, you can see this region. So let me just bring your focus to here. You can see that this area, right, it's a previous support turn resistance area. So those of you guys who are looking at graphical levels, you can see that this was a previous support level. It was a support turn resistance area. You see how price interacted with this region. So let me just maybe switch to line chart. You can see it very clear here. There is supply, right? There's support region. There's support region. And then there is resistance here, right? So price failed, close below it, tested as a resistance. And then following which, what happens is that you see a clear wick above this zone. You can see that this is the supply region that we have over here. So this is the supply region that we have over here. And what happens is that price came in and it just wicked slightly above this region. So recall that we talked about liquidity sweep earlier on, right? So this is your liquidity sweep. Price came in, it sweeps slightly higher. Oops. Let me just put it in a different color. Let me just put it in purple and let me darken it. So you can see, right? So essentially, price still holds within this gray zone, right? Which is this supply region that we have. But what you see following this is that it sweeps slightly above this gray zone, but it fails to close above it. And then this region then creates a order block for us. So this area here, right? So this would be the region for entry. You can see that this candle would be the candle. The price came in, you can see if I have to extend further. So let me just bring this up. You can see essentially, right? So price came into this region. So let me just go down to the smaller time frame. So right now I'm on a 4 hours time frame, right? You can see how it plays out here. Price push lower, it creates a valid supply area. And this supply area itself also sweep liquidity. You can see on a 1 hour clearer as well. So what happens is that demand fails and then price came in, tapped this region. You see a clear break and a clear sweep above the high, this region. that we have, right? This gray zone, and the price continue to the downside. And once that happens, you can see that if you were to narrow it down on the 1 hour, so this is the 4 hours, right? So if you want to narrow down the region on the 1 hour, essentially this is the candle that caused that sweep. You can see the 1 hour candle. This is the candle that caused that sweep above the purple region here, this purple line, right? So this is the area that you see the resistance price came in, just tap it slightly higher, take out any orders that you have, right? Stop losses lying slightly above here, and then it creates a valid supply region where price came in again, tap into this region as you can see, and then it continued to the downside. But what's important to recognize is that even prior to this move itself, you can see that there's already bearish market structure formed. You see this lower lows and lower highs that are being formed over here. Okay, so there's bearish market structure that's being formed. And along with that as well, right, there's demand failure. And this is the same concept that we've covered in the first slide, right? So demand failure creates supply region and vice versa. So this is basically how you can apply right across the different time frames, right? If you want to go down to the smaller time frame as well, so now that price came into the 1 hour, this is your 1 hour supply region. Let me just remove this marking, right? Same thing, right? So on this 1 hour, let's focus on this portion of the chart. So price came in, tap into the resistance area. You can go down to either the 15 minutes, 30 minutes, right? Same thing, try and find the same confirmation. So what you have over here, right? So support resistance areas, you can see this region very clearly. So price came in, tap into this resistance area as you can see, right? So for those of you guys who are comfortable or familiar with using just horizontal support resistance level, you can see this level over here, very clear region, right? So there is this support area, turn resistance, price came in, sweep slightly, and you can see that when price stays above this region on the smaller time frame, this is your 15 minutes, right? Now this region itself is a support area. So what we need to wait for is just a clear break below this region to take the shots, right? And also keeping in mind that it's on the higher time frames resistance. So note that this is your 4 hours region, right? This gray zone that we've highlighted. This is a 4 hours resistance region, right? That we found earlier on, right? As we have mentioned. So this is one way you can combine support resistance or rather supply demand areas, right? Looking at how price interact with one another. So again, supply region, when it fails, it creates demand regions and vice versa. So let's just do a quick review, right? A quick summary of what we've covered so far. So I hope that this quick 30-minute session in terms of just covering supply demand areas and also using the chart examples that we have just to show how it applies, it's helpful, right? So what's important is that I think throughout the session as well, you guys saw, right? So it's important to identify market structure. So look at whether it's a bullish and bearish market structure instead of just taking this chart in the middle of nowhere. Okay, so it's important because the market structure will help you in guiding you in terms of the direction. So as much as possible, try to go on the higher time frame, right? On the 4 hours, the 1 hour. So 4 hours market structure, the time frame itself will hold more weight as compared to maybe your 15 minutes or your 5 minutes. So in general, when prices are in a bearish market structure and a downtrend, right, you expect price to form your lower lows and lower highs. In a bullish market structure, we expect prices to form our higher lows and higher highs. As we've mentioned in point 2, right, higher time frames hold more weight. So if prices are on the daily supply region or daily supply zone that we have over here, as with the example that we saw on Aussie dollar, right? So let me just bring that chart back up so that you can see here. So in general, you can see, right, let me just clear the drawing. So you can see over here, right, prices are on the 4-hour supply region. On the smaller time frame, 15 minutes, you see that there is this resistance turn support area. This could be a breakout to some people, but understand that on the higher time frame, it's sitting on the supply region. So what you want to wait for is a confirmation of the support, right, or demand zone failure. So this is how you can combine the higher time frames with the smaller time frames. So higher time frames will help in guiding you in terms of direction of the market, right? And then you can just go down to the smaller time frame and try and wait for confirmation of failures, right? Basically for confirmation and play in the direction of the higher time frame. So also understand this, right? That all the zones that we've highlighted over here, understand that they are not definite buy and sells, right? So with the interaction that you saw earlier, right? Supply zones, right? When supply zones or rather when demand zones fail. So the first slide that we saw, right? When demand zones fail, it creates in a bearish market structure. When demand zones fail over here, it creates a supply zone that we can take sales from. But also understand that, right? There are areas. So imagine that this is a strong push down, right? In a bearish market structure, you have a push down and then a pullback. Price can come into supply areas that it's here, or supply regions that is here. So in this case, right, it's important to understand that while we highlight this zone, it gives us a higher probability of the trade. Understand that zones can fail as well, right? So there's always a chance that we'll be wrong. So we want to trade according to what the market tells us, right? So it's important to have proper risk management in place. So risk about 0.5, so depending, right, 0.25, 0.5, or at most 1% on your trades, right? So don't understand that it's important that you practice proper risk management in place so that we ensure that trading can survive in the long run. So this is a brief summary of what we have in terms of supply and demand zones, right? So I hope that this session has been helpful and basically help you to understand a little bit more about how this works and how you can apply it across the different time frames. So I think we have come to the end of this session. So yeah, so we've come to the end of this session, right? So for tomorrow, we will be having our live analysis session as well. So this is where we'll hop on to the charts. We'll also do a review of the calls that were made yesterday. So do join us for that, right? So you can go to vantagemarkets.com/webinars. So we have the schedule out for the session. So just sign up from there. You can see vantagemarkets.com/webinars. Just go to Friday and then you can click on the session and a Zoom link will be sent to you. So this is what we have for today, right? So I hope that the session has been helpful, right? We will catch you guys again tomorrow. So thanks everyone, and we'll catch you again. Stay safe and trade safe.